Welcome to this explainer, where we are going to demystify the dense Q4 2026 financial data of Microchip Technology. We're translating those raw numbers, earnings transcripts, and balance sheets into a really clear, structured investment profile. If you've been tracking the semiconductor space lately, you know it's an absolute wild ride right now. So we're going to strip away the noise and look strictly at the data to see exactly how MCHP is navigating the currents. Let's get right into it.
Here is our roadmap for today. We'll start with empowering diverse markets, then break down the Q4 2026 earnings, look at the supply chain squeeze, check out the valuations and ratios, and wrap up with the dividend story.
Okay, Section 1, Empowering Diverse Markets.
Before we hit the balance sheets, we have to look at MCHP's massive footprint. They aren't just relying on one trendy sector. They're providing hardware, software, and total system solutions across aerospace, defense, automotive, industrial automation, and of course, those rapid growth AI data centers. This kind of deep diversification is essentially their armor against localized industry downturns.
That diverse portfolio creates a really durable moat. They are actively leveraging cutting-edge standards, things like PCIe Gen 6 and Compute Express Link, or CXL, to maintain heavy demand in high-bandwidth data centers. At the same time, their proprietary PolarFire FPGAs are highly sought after in aerospace and defense simply because they draw incredibly low power. So what we're looking at is a highly calculated mix of durable, long lifecycle tech and disruptive growth trends.
Moving on to Section 2, the Q4 2026 earnings breakdown. Let's see how this builds into the hard numbers.
Now, you really need to notice the massive scale tipping here between GAAP and non-GAAP operating income. On paper, under strict GAAP rules, they posted $490.1 million, which is 10.4% of sales. But the non-GAAP figure? That's a massive $1.238 billion, representing 26.3% of sales. So why the huge gap? Well, their GAAP numbers are heavily weighed down by non-cash purchase accounting adjustments and restructuring charges from previous acquisitions. The non-GAAP figure honestly gives us a much clearer look at the actual cash-generating power of the core business right now.
Looking at the broader fiscal year, they drove net sales up 7.1% year-over-year to $4.713 billion. That demonstrates incredibly solid top-line performance, especially considering some very complex market dynamics we're going to touch on in a minute. Because of that top-line performance, you can also see that resulting EPS divergence, $1.64 non-GAAP versus just 22 cents GAAP. Also worth noting, they benefited from a highly favorable non-GAAP cash tax rate of just 8.6% for the fiscal year, which was really aided by stronger than forecasted pre-tax profits in the fourth quarter.
And that brings us to their future targets. As Executive Chair Steve Sanghi noted on the earnings call, when he came back to the helm, the gross margin was sitting around 52%. He actually took a lot of flack from the market for setting an ambitious long-term gross margin target of 65%. But as this long-term model shows, they are rapidly closing in on that exact goal, hitting 61.6% in Q4, with guidance pointing towards 62.75% for the next quarter. They're getting it done.
One metric that perfectly highlights their operational tightening is 185. They closed March with 185 days of inventory on hand. Now, this represents a strategic reduction of 16 days from the prior quarter. Management noted that their inventory reserve charges are normalizing, turning what was once a serious headwind into a much more manageable situation. They are essentially untrapping cash that was just sitting on warehouse shelves.
Let's pivot to Section 3, the supply chain squeeze, because these strong margins don't exist in a vacuum. 70% to 80% of the process technology nodes are constrained. Can I grow a business 50% in one quarter? No. This quote from Steve Sanghi perfectly highlights a major bottleneck MCHP faces right now, with foundry capacity remaining very tight and substrates highly constrained across networking, data center, and automotive lines. Their ability to instantly capitalize on a massive spike in demand is quite literally physically capped. Lead times are expanding, and while it's not a crisis by any means, it requires incredibly active management to secure additional wafers. Furthermore, management explicitly acknowledged past friction during previous market cycles, where customer relationships were definitely strained. Their current strategy is laser-focused on healing those bonds. They are actively choosing to absorb some input costs rather than pushing broad-based, indiscriminate price increases onto their strong partner customers. It's a really smart play for long-term loyalty over short-term margin padding.
And here is the biggest immediate headwind keeping them from instantly hitting that 65% gross margin target: underutilization charges. In the last quarter, this amounted to $46.6 million. Essentially, because their factories aren't running at maximum capacity, their fixed costs are spread over fewer chips, which hurts margins. But management expects these charges to clear out in coming quarters as factories ramp back up, which should natively push them right to that 65% target line.
All right, Section 4, Valuations and Ratios. Let's look at the current market cheat sheet.
Just look at the staggering difference here between the trailing PE of 422 and the forward PE of roughly 29.5. This massive gap tells us the market is heavily discounting those past GAAP accounting charges we talked about earlier, and they are pricing in a massive earnings normalization for the coming year. Alongside this, we see a very healthy balance sheet, marked by a debt-to-equity ratio of 0.85 and a current ratio sitting safely over 2.
This recent market momentum is so clear when we look at the timeline. The market cap expanded nearly 40%, jumping from roughly $35 billion at the close of the fiscal year up to $49 billion by May 2026. The market is absolutely rewarding their margin expansion and diverse market footprint, driving multiples like EV to sales and price to book significantly higher in a very short window of time.
Finally, Section 5, the dividend story. How is MCHP rewarding the people holding the stock?
A quick look at their recent quarterly cash payouts shows a rock-steady, unwavering distribution of 45.5 cents per share over the last 3 periods. In an industry known for wild cyclical volatility, this kind of predictable cash flow is exactly what dividend investors are hunting for.
Now, what stands out here, the absolute elephant in the room, is an incredibly high 827% payout ratio. Before you panic, remember this is heavily distorted by the GAAP net income figure we discussed earlier, which was dragged way down by paper accounting charges, not cash losses. On an actual cash basis, this dividend is well supported, offering a 2.01% yield and boasting an impressive streak of 14 consecutive years of dividend growth.
And just to put a concrete dollar amount on that commitment to shareholders, in total, Microchip Technology successfully returned a massive $984 million. That is nearly $1 billion to investors through dividends during fiscal year 2026 alone.
Which brings us to the ultimate question. We want to leave you with this final thought to ponder today. As Microchip Technology expands deeper into explosive sectors like AI data centers and defense, will their physically constrained supply chain hold up enough to keep this impressive financial engine running? Or will the physical realities of chip manufacturing force a slowdown in their margin expansion? The numbers show a company executing brilliantly on what they can control. Now, we watch to see how they handle what they can't. Thanks for joining me on this explainer, and I'll catch you next time.